Awesome. So first and foremost, thanks everyone so much for joining today's webinar, Optimizing Amazon Cash Flow from Forecasting to Profit. My name is Jeff, and I'm the head of marketing here at A2X, and I'm going to be one of your co-hosts. I'm joined by Tyler Jeffcoat. And for those of you that don't know Tyler, he is an OG in the e-commerce accounting space. He's the founder and CEO of Seller Accountant. And over the years, they've helped hundreds, if not thousands, of e-commerce businesses get accurate financials so they can make informed decisions about their business. And we're so excited to have Tyler joining us here today to share his expertise on an incredibly important topic. Tyler, before we jump into today's topic, would love if you can kind of give a high-level overview of Seller Accountant. Hopefully I did it a little bit of justice, but give a little bit more depth for everyone that's joining us here today.
Yeah, you nailed it, Jeff. Thanks for having me. So again, guys, I'm Tyler, Seller Accountant. We do bookkeeping. We do fractional CFO. We do it for a big pile of e-commerce brands. I also lead a mastermind for 7- and 8-figure Amazon sellers called the Sellers Roundtable. And I think we're just on a quest to help our clients make more money. Bezos is going to get paid, guys. Shopify is going to get paid. We want the $1 to $20 million brand owner to get paid. And so it's been our quest for 5 years. I sold a healthcare business with 100 employees in 2017 before diving into this racket, and I'm having a great time doing it. Love A2X. Eager to talk about how we use a tremendous amount of this tool to make our practice better.
Awesome. So for everyone in attendance, I've got to say, like, Tyler knows his stuff. So there's going to be a lot of information in the webinar. It's going to go hard. It's going to go fast. My role here is to ask some questions, add a little color, maybe ask Tyler to provide some anecdotes. So for today's agenda, we're going to talk about the way forward without Amazon lending. We're then going to chat about how to manage cash, specifically answering how much can I grow while paying myself, ROI mindset for inventory and advertising costs. We're then going to jump into how to build a cash flow forecast and use some semi-real world examples. And then we're going to jump into Q&A. So Tyler, let's now jump into the elephant in the room. Amazon lending discontinued.
Yeah, guys, you guys know this. It happened a few months ago. March 6th was the day. And this is this series of emojis here is how we used to feel. If you guys can empathize with this, we would be stressed, right? Waiting for Amazon to make another offer to lend us money. And that stress would turn into relief when Amazon made us an offer. We would take the loan because it was easy, and we would feel strong because our business had cash all of a sudden. Well, now we're using the same emojis, but the feelings are different. We learned on March 6th that Amazon's not going to make any more offers. They're not going to underwrite any more loans. And now we're kind of having an oh crud moment. We're like, oh no. And instead of feeling relief, we're sweating our cash flow. We're trying to figure out how can we have enough capital, enough working capital in our businesses to fund our POs, advertise our products, and be successful. And so we're at a bit of a crossroads here. And by the way, if you're on this webinar or consuming this content, okay, we're a few months after Amazon discontinued the program. And so we've had to figure something out to make money appear in our account if we need it. But you know what, Jeff, for some of our clients, things got ugly back in March, and they really struggled to raise enough capital to get from the awkward, like, pain point of being stronger as a business. And so I want to make sure that we spend as much of our energy in this webinar today talking about how we can actually get stronger where we're not as dependent on loans, whether it's from Amazon or anyone else. And, I want to use a couple of paradigms. I'm going to give you one habit. It's so easy. It's going to take you 5 minutes a week to apply this habit. First, I got to teach you how to think a little bit. And I'm putting on my CFO hat here. By the way, you don't need to be an accountant to do any of this stuff we're going to talk about here. You need to be an operator that cares about making money in your business. So I want to teach you how to be intentional with your growth rate so that you can afford to pay yourself and grow your business. In addition to that, I want to talk about my pet KPI. This is the one that probably, if you've seen me at a conference, I speak all over the world about return on working capital. This is my soapbox about how do we have an ROI mindset with our catalogs. We got to, and then we'll walk through how to do a weekly forecast. Jeff, any questions before I dive into the technical nitty gritty here?
Yeah, like you had mentioned that a few of your clients were going through it in March. Just so that everyone understands the extent of the problem, like what percentage of your clients were using Amazon lending?
I would say a seller account, and again, we help lots of sellers, Amazon and direct to consumer. Probably almost half of our clients had some kind of an Amazon
It's a
loan.
lot.
Yeah. And maybe not now, maybe only a dozen or so clients were dependent on that Amazon loan, right? I mean, we had several guys that, oh, if they don't end up in bankruptcy, we're close because of the weight of that debt on their balance sheet. For some people, it's just an annoyance. And for those of you guys listening, that might be you where you're like, oh, this is just annoying. I wanted this cash to grow. But I would almost guarantee you, Jeff, that a few people listening to this or consuming this content have been in the place where they are. I mean, this is my entrepreneurial journey. I've started two companies. I wasn't great at running cash for either of them for at least some moments where, we've all had that like 2:30 in the morning fetal position. Am I going to make payroll tomorrow feeling?
I don't mean to laugh actually at your, I just, yeah,
Yeah,
sorry.
no, thanks a lot. Thanks a lot. I'm just kidding. But like, yeah, no, but listen, like that's part of the entrepreneurial journey. And Amazon made that a lot harder for us in
Yeah.
an ecosystem where it was already kind of hard to raise cash. And now we're like, oh boy, now what do we do?
You talked about folks kind of looking at alternative solutions and because they obviously had to figure something out post March.
Right.
And I'm sure that when you said that, a lot of people in the audience probably perked up and want to know maybe like, whoa, what were some of those alternative solutions? Is that what I've used? Are there other options? What have you seen? And I don't want to ask you what you would recommend, but I like what have you seen?
I mean, I think if you have the option as like as a US based entity to get an SBA backed loan, the Small Business Administration, that's always going to give you two advantages. One is it's going to have the lowest interest rate, and two is it's going to give you the most time horizon, right? I mean, I had a client get an SBA loan last month. That's a 10-year time horizon. So for anyone who's like feeling a lot of resonance with this Amazon lending thing, like having 10 years to pay back a loan feels insane. That's an unbelievable amount of time. And so step one is always to get cozy with a local banker and try to get an SBA line of credit. If I don't have time to wait for the SBA, which is tends to take a lot of time, or if I don't qualify for SBA lending, then there are still a number of these alternative lenders, Sellers Five, Paraffin, 8Fig. I don't even know if AccrueMe is still in business, but there's a number of these guys that were giving loans. And the thing that I just want to encourage you, you've got to be organized in your financials. Jeff, you mentioned this a minute ago before we hit record here, but like, guys, listen, you're not going to get premium loans. I mean, the kind of loans that you want, the ones that don't have garbage interest rates, unless you have good financials. You've got to have a good deck to come in before your lender. But here's the other thing is Jeff and I were laughing about one of our favorite movies called The Big Short, right? Where all these crazy people were getting mortgages even though they didn't have any income. And so just because somebody will give you money doesn't always mean it's a good idea. And so having good financials where you can take a look at your business and say, oh, I'm healthy enough. Let's do this. I can afford to grow at this rate versus, boy, I am not healthy enough. I need to slow down, find some things to simplify before I move forward.
And that's why I love some of the cash flow examples that you have here because some of them talk about cash flow forecasting with a loan and some talk about it without a loan, right? So regardless of the situation that your business is currently in, a lot of the content that you're going to be talking about, the paradigms, the habits, the reports will apply to you regardless. So let's jump into it because it's a lot.
Yeah. So let's go into a couple of really simple but like important mindset paradigms I want to give to you guys. One is, guys, you can actually use a simple calculator. You don't need to buy one of these. You can just use an Excel spreadsheet and you can calculate how much your business can grow given the amount of resources that are currently in it. And so just to give you a couple of quick examples, looking at example one here, if I wanted to know how much I can afford to grow in the next year without taking on a dime of new debt, what I would do is I would look at how much cash my business is generating. I would look at what those demands are on that cash, right? So maybe I need to get paid. There's maybe some owner draw I need to take, or maybe I got to pay down another loan. All that to say, I'm going to be left with some amount of growth capital in my business. And here's the thing that is so simple, but if you guys grab this, it'll make forecasting so much easier for you. And it's this. I can only grow my e-commerce business at the rate I can afford to grow my inventory. Like, and believing anything other than that is normally believing your own BS. Like, unless there's some wildly different business model that you're getting into, or you've improved your inventory terms substantially. Normally, if I want to go from $1 million in sales to $2 million in sales, I'm going to need to double whatever my inventory was. And so in the example on the screen here, given the variables, I generated 500K in cash. I'm going to pay myself 125K. I'm going to pay down some debt. I can afford to grow exactly 23%. That's a really helpful number because I can use that number to plan in advance. I'm not going to take on any debt. I can afford to grow at this rate. But let's say that I want to grow beyond that rate. Let's say that kind of come hell or high water, I'm going to double this year. I want to grow by 100%. Well, I can use a similar simple cash flow planning tool to calculate how much new debt I need to take on in order to succeed. Because one of the worst things that you and I can do is we can decide to try to double our business and then not have enough cash in the hopper to fulfill our orders. I'll give you an example of this. I had a client back going into Q4. So we were just getting into the hot season for this product type here at the end of 2023, and we ran out of cash. Couldn't fulfill the last order, and like literally the company stopped the truck and didn't deliver the product.
Mm.
And so now we were left not able to sell 7 figures of inventory in our Q4 rush that really made a big impact on this client's year. And it's because we didn't have enough of a plan to know how much cash we were going to need to successfully grow that quickly. Now, in hindsight, he wishes he had picked a more kind of sober growth rate. Let's not grow 100%. Let's grow 50% because then we could afford it given the amount of cash that we have. So pause here for a second, Jeff. Any questions about kind of how to calculate growth rate?
No, I think it's great. And it also speaks to you want to avoid a situation where you need to take on bad debt.
Yeah, I think that's right.
Awesome.
No. Okay. So let's kind of pivot into our second mindset kind of paradigm I want to share with you. And guys, I'm gonna acknowledge that this is the deep end of the nerd geek KPI CFO pool. But friends, I just want to give you a couple of anecdotes really quickly here. During the feeding frenzy where Amazon sellers and direct-to-consumer brands were being purchased at outrageous multiples, we had a lot of private equity money, we had a lot of aggregators. During that feeding frenzy, the KPI that I'm about to show you was predictive 100% of the highest value deals. In other words, if you can get this KPI right, you will make your business more valuable. The flip side of that, I think as of today, all 4 of the bankruptcies that I've seen amongst our portfolio of clients over the last 2 years, all 4 of them had the bad side of this KPI. In other words, this is one that you've probably never thought of before, but you need to start using this to compare your products with each other and your sales channels with each other. Okay. So I am the kind of guy that invents KPIs. Forgive me. The first one I invented about 6 years ago is called PAG. It's post advertising gross profit. I just mean real gross profit. In America, accountants like me, right? We're normally wearing a suit and have more hair. It's not exactly me, but like these accountants love having your gross profit be kind of confusing, not all inclusive. I don't like it. I'm sorry. Unless GAAP accounting forces you to put your advertising down below the line, your Amazon fees, I want as pure a picture of my unit contribution margin as I can possibly get. And so PAG is that. By the way, 25% would be pretty good for an Amazon seller. But now if I take that profit divided by my COGS, I get a batting average. Guys, I love baseball. My beloved Georgia Bulldogs didn't quite make the College World Series, but we had a great season. And your best hitters have the best batting average. Their impact per plate appearance is the highest. In the e-commerce game, we call that return on inventory investment. The higher this percentage, the better. And this kind of gives me a good picture of every time I turn my inventory, how potent is this product? How much impact does it generate for me? And now I get to do something magical. I get to compare it to what I have invested. I mean, let's think about this. Jeff and I are going to buy a piece of corner real estate in Toronto, and we expect this real estate to generate some profit for us. But if I were to tell Jeff, hey, Jeff, we're going to make $1 million a year on this investment we make in downtown Toronto, Jeff, because he's a smart guy, would say, wait a minute, I don't know whether I'm happy with that $1 million profit until I know how much we had to invest to get that $1 million profit. Now, if we invested $100,000, we'd
I'd
be
be
pretty
happy.
damn happy. But if we invested 120 million and only got $1 million profit, we actually might be really, really sad at that profitability. And so when it comes to your inventory investments, here's how you do that. Let me just show you these slides. If I can compare my return on inventory investment, that's the batting average number, with the amount of at bats I get per year. Jeff, you and I geek out on poker sometimes. EV game theory is all about taking an expected value computation. Guess what? In the inventory game, here's how you do that. What I want to do is I want to take my batting average, which is 83%, times the number of at-bats I get per year. That's how many times I'm turning my inventory per year. This guy gets 5 at-bats. That means his expected value per year is 4.17. What that means is for every dollar I beg, borrow, steal, invest in this product or this inventory, after 12 months, I get that dollar back plus $4.17 in profit. This actually would be really, really good. This would be a very strong return on working capital. But let's say you look at your return on working capital and it was bad. If it's less than 1, you're not going to be very happy. What do I do about it? What I do about it is I try to identify what my problem is. Either I have a low batting average or I have low velocity. And if I determine that the problem is that my velocity is low, which is not the case on the screen, by the way, 5 turns a year is a pretty decent velocity. But if I determine that I want to improve my velocity, I'm going to do things like call my suppliers and try to get better payment terms. I'm going to do things like get better inventory management systems in place so that I can wait longer to order my product and not have as much stuck in my supply chain. I'm going to do things like basically, I'm going to do anything I can to stretch my cash cycle, to speed that cash cycle up. If I'm doing, actually, I have a client that her biggest customer is Petco. And Petco is notorious for sometimes paying their invoices right on time. Sometimes they stretch you out 70 days. And so she went to Petco and she said, nope, you're cut off. Not going to give you terms anymore. You're going to have to pay me more quickly or I'm walking. I'm sorry. But what that did for her is it shortened her cash cycle enough that she could, be healthier from a cash flow standpoint. So, guys, I have so much content on return on working capital. This is a nerdy thing, but just know this. If you are a reseller and only have like 15% PAG, but you can turn your inventory 12 times a year, you may still be just as happy as a brand owner that has much higher margins, but has zero velocity. And so my whole point is just saying you can't ignore the inputs when you're determining whether you're happy with an investment. No more than Jeff and I could ignore what we invested in a piece of real estate to know whether we are happy with its performance. That's a really hairy topic there, Jeff, and I'm touching on it really quickly. Any
Oh,
questions about
I think it's great. I mean, like this slide for me perfectly encapsulates. Like sometimes it can get a little fluffy. We say like, oh, you need accurate financials. You can make important business decisions. But like you've just clearly articulated how financials can inform the decisions that you make about your business. It gives you insights in particular different areas, and then you're using those insights to actually drive change. I did want to ask one question. Well, actually, I have 2 questions, but my first question is, you had mentioned that 4.17, that would be great. Can you give me kind of like what great, average, and bad would look like for this metric?
Yeah, so for return on working capital, anything less than 1x per year, anything less than 1 is bad. Anything between 1 and 2.5 is kind of a typical range. And by the way, if you download our free tools that we'll have here at the end of this, like I actually have a scale on there, Jeff, where it'll show you how to compare it. But like anywhere between 1 and 2.5 is kind of typical. That's okay. And anything more than 3 is normally what's called elite. So the one you're looking at on the board right now is actually a really strong performing asset. Like, hey, listen, let's not show the crappy ones. This is a good asset. This is an
Yeah.
asset that has decent margins and really good velocity, and this should be aspirational. And so, yes, that's how I would answer that question.
And you mentioned that this metric is probably one of the best predictors of exit multiple. So talk to me about kind of like what you've seen from an exit multiple perspective as it relates to those that are in the average bucket, because obviously if you're below average, then you're worried about the worst possible case scenario, not necessarily an exit. So the average bucket, and then in the elite bucket, like what, and we could talk about what it was during the ZERP era, and we could talk about what it is now and what you're seeing now.
What's interesting, so I had the privilege of advising 5 of the boards of directors for the aggregators. And every single time, with the exception of one, when I got involved over the kind of feeding frenzy of 2020, 2021, they weren't even getting a balance sheet as part of their due diligence. In other words, there was a lot of really irrational behavior happening. And it was a little bit understandable because there was such this like, oh, we got to get in quick, 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 quick. But sometimes quick, quick, quick results in, Thrasio, what is it yesterday? The press release that they're just exiting their Chapter 11 bankruptcy. And so
Like all the aggregators are struggling.
yeah, a lot of them are. And it's because they overpaid, and it's because they didn't understand what you're asking right there, which is I might feel really good about my margins, but if I have really high capital needs, there's a slide from another deck I wish I'd added here, but like there's so many examples, Jeff, that I could show you of brands that are kind of similar, but one of them required 4 times as much inventory to operate it than the other one. And those are the ones that just need a ton of cash to be stuck in them are the ones that you have to be really careful valuing. So from the perspective of a seller or a brand owner that's out there listening to this, whereas multiples were kind of insane a couple years ago, right? You could get that 5, 6, even a couple of these elite return on capitals were getting like 8x kind of multiples. And you're not really seeing that anymore. Most of the deals are kind of back to right around that 3x multiple. And that's a 3x of SDE. So that's sellers discretionary earnings. So, right. If you pay to go to a conference, they're going to give you that as an add back, right? You're going to be able to adjust those trailing 12-month earnings. And so but here's the point is that a lot of those investors have become much more sophisticated at using these kinds of metrics to value businesses. And so nowadays, if you go to the party and you have a 4.17 return on working capital, you can expect more like a 4 to 5x multiple even now when the rest of the market's going to get that 2.5 to 3.5x.
Nice. And then my last one on this slide is like you've given us an analogy on The Big Short. You've talked about poker. You touched on baseball, and you haven't given us anything on Moneyball. I just can't believe it.
Another great movie. Another movie that's probably like sneaky in my top 10 is Moneyball. Yeah, if you guys haven't seen that movie, it's great. It's math nerd meets baseball. Yeah. Jonah Hill at his best. Yeah, Brad Pitt's incredible in it. So another great movie. Yeah, again, it's funny. We anytime for me, I don't know if you guys are like this, but anytime you can combine like math in competition, like I'm game, like get me in there. Like I'm such a nerd. Like I love chess. I love poker. I love things like Moneyball because I like want to try to find an edge and win. And I just want to say that I think the more sophisticated Amazon sellers are actually kind of adopting more of that mindset for their portfolios. Because it used to be like, Jeff, like 3 years ago, it was like grow, 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 grow. It's like, let's just add more products, add more products. We could never fail. This will never end. And what we're realizing now is no, we're going to have to be smarter. Like back to our first example, like a couple of slides ago, right? Like we may actually have to prioritize, right, our best products because if we're going to grow, we only have X amount of cash in the hopper. And then looking at this analysis we just did, okay, if you could give yourself one gift coming out of this webinar, guys, go home and calculate this thing on the screen for each of your top 10 products. If you have a huge catalog, don't do it for all of them. Do it for your like top 10 products. And have this discussion with yourself. Okay, for my top 2 or 3, my top 20%, I'm never stocking out of those. I'm never, ever going to stock out of my products that have my elite returns on working capital. And for the ones that are the bottom feeders, I'm going to put them on a 60-day probation. I'm going to kill the products if they're not performing because my capital is too precious right now to put into products that are not going to work at scale.
Yeah. And then if they don't want to do it themselves and they want to work with you, you'll help on this endeavor, right?
Like some of this you can do for yourself. At some point, if you need help, teams like Seller Accountant can step in and be your kind of when you hear the catchphrase fractional CFO and you're like, what the heck does that mean? It basically means somebody doing what I just described for you, and then hopefully on a plate giving you, hey, here's the 4 products that really need to be rehabbed. Here's a product we probably need to kill. Here's where we need to raise some cash in advance, like that kind of thing. So that's where that service comes in. Any more questions here, or I'll go to our next point here?
No, I think that's great. Like really wonderful overview.
So you guys know your simple cash cycle. The unfortunate part of yeah, let me just compare your business to my business here, right? In an accounting firm, I get paid, I do work, I pay people. My cash cycle is really, really simple, right? But as an inventory owning business, and I sit on the board for one of the tiny aggregators now, where we own a ton of inventory. We have a cash cycle that sometimes can span 6 months, sometimes it can span 4 months, that kind of thing. Between when I have to pay for my inventory and when I actually get paid from Amazon or Shopify or whatever it is. And so I want to give you this really simple, really straightforward tool. You can, we'll have a link to a free version of it. You can steal my template. Feel free to, it's fine. But like, here's what you're going to do every single week. And it's going to make you able to sleep at night without worrying about running out of cash. I would do Monday morning, but it's just me. I'm going to come in on a Monday morning and I'm going to say, okay, here's my beginning bank balance. And then I'm going to go and I'm going to put in all the money I expect to have in terms of income for this particular week. Amazon's going to deposit some money. I've got my wholesale order. I got a loan coming in and all the money that's going out. And this tool is going to calculate, okay, for the week, I was negative $7,121. That means I ended the week a little less cash than I started with. No big deal, that happens. Some weeks are going to be better than others. But the power of a tool like this is if I forecast out 5 weeks and I see a negative bank account balance at the end of the 5th week, like you guys see on the screen here, that needs to be red alert, 5 alarm, fire alarm kind of thing. And it needs to be now. I don't want to wait until the week of July 14th to try to address this cash crunch, because that's when I feel really stressed out and I have to take the worst loans with the worst terms. I want to be stressed out about this today, because if I'm stressed out today, I can fix the problem, right? I can either call a couple of providers and say, hey, I'm going to have to pay you a little bit later, or I'm going to, choose to make a different choice with my credit card payment, or I'm going to do, what's on the screen here. I'm just going to get a $25,000 loan in advance so I don't run out of cash. And so my point is that if you think about coming in, we're really close to August here. We're getting close to August in 2024, and you're going to be making those final inventory purchases for your Q4 push. And you want to have a plan in place, and it's going to feel lean because some of our brands don't have great summers and we're going to have to pay all this money. And so having this plan to realize, okay, I'm good. This is not a tool. This is not sophisticated, but it's something that can give me an imminent week by week plan. At Seller Accountant, this is something that we update for our clients every single week. And the reason we update it is because this has a big impact on the peace of mind for our customers. And so again, feel free to grab it. I've got some tools here. I guess, Jeff, you're going to post those in the chat for everybody. We'll make sure that they're in the show notes as well if you guys are catching this on YouTube. But just, guys, there's some simple tools that if you use them, you can become a more sophisticated operator, given the fact that cash is harder to come by now than it was a few years ago. And if you do that, you're going to be so much happier, and you're going to build enterprise value into your business where, I'm going to be honest with you, don't sell your business this year unless you're premium, but you might sell it next year or the year after that. And right now, in the middle of 2024 is when you're making your millions that you're going to be able to harvest in a year or two. Yeah.
And if you're watching this webinar on demand on YouTube, we'll put these links in the description below so you can get access to them there. And if you're watching this on demand the next day, it'll be in your follow-up email.
Cool. Oh, funny, goofy holiday party picture for me and my team. If you do want to learn more about Seller Accountant, by the way, selleraccountant.com, lots of free resources. Love to talk to you if you're looking for bookkeeping or fractional CFO help. And yeah, yes, I do still have that sweater. So, for the right price.
Is it like an ugly sweater party and you were the only one to bring one?
It's one of those where most people didn't get the memo, and I'm like, really?
Yeah.
That's actually the only part of this. I may be one of 3 people that actually got the memo that we're supposed to look absurd, or maybe I just didn't know and just screwed up and wore my Olaf sweater.
Or they were messing with you. That's awesome.
Yeah, no. Everybody tell Tyler that this is going to be a weird Christmas sweater thing, and then we're all just going to wear normal clothes, and he's going to look like an idiot. Nailed it. They nailed it on that one. It was great.
Yeah, exactly. Hey, Tyler, I got to say, it's been amazing hearing you talk about this topic. You're obviously very passionate about it. And for me, it's just another reminder of I mentioned this earlier in the webinar, but I think it's also just an incredible reminder that accurate financials, it's not just about compliance. It's not just about tax. It literally can mean the difference between a profitable, successful business and one that could potentially be losing money and go bankrupt. And then there's also kind of like the best possible case scenario, right? M&A, selling at, great multiple, so on and so forth, or acquiring loans at favorable rates.
Yep.
It's just like an awesome reminder to hear somebody like you talk about this, who's so passionate and who's seen it be incredibly helpful for all of the businesses that you've worked with and worked for. So thank you again. And then here, so a lot of what Tyler has been talking about, not only does it require time and effort from you as the business owner, potentially from an outsourced accounting firm like Seller Accountant, but can also make it a little bit easier with automation technology like A2X. Tyler, you're on the webinar. I'd be remiss if I actually didn't let you pitch A2X here rather than me.
I would love to. So let me tell you, so A2X is amazing, guys. If you're on the fence about it, I definitely recommend trying it out. And the reason that Seller Accountant, as an entire accounting firm, will not take an e-commerce brand on as a client, right? It's a hard no. We just won't do it unless they allow us to get A2X for them. It's for two simple reasons. One is if I'm trying to get accurate accrual financials in a timely manner, coming out of the marketplace channels in particular, A2X does it. It does it right. It does it perfectly. And it makes our jobs easier as an accounting group because guess what? Even great professional humans can make errors. And so having a tool that makes it kind of like dummy proof on a given day is really important. The second reason is Seller Accountant I'm really grateful to have been a part of over $100 million in exits over the last 3 years as kind of the fractional CFO boy, or maybe it was one of our bookkeeping clients. And we went through some rigorous due diligence. I mean, private equity, Price Waterhouse, Deloitte level due diligence. And the bookkeeping that included A2X, it was no big deal. It was so easy because it documents the source and the math. I can't tell you how annoying it is as an accountant that does diligence myself to look in QuickBooks or in Xero and not understand how we arrived at a number. So something as simple as attaching how we calculated cost of goods sold or where the data source is makes a world of difference if you're trying to get better lending or you're trying to sell your business. So big fan of A2X, definitely check it out.
Yeah. And what's cool is like a lot of the reports that you showed, A2X acts as an input to get you some of the numbers that you saw on those cash flow forecasts. So we actually did get a few questions, but man, you went into so much depth that I think you answered a lot of questions as you went through the webinar. I'll jump. We have 3 right now so far. And if you have any more, please feel free to ask. So the first one is, comes back to one of our earlier topics. How are the SBA loan interest changes impacting sellers? And this is obviously across your client base.
Yeah, I'm seeing this message over here from our mutual friend, Scott. So I'd be interested in exactly what interest changes he's talking about. Obviously, interest rates are bad. The way interest is calculated is obviously fundamentally the same. So I wish I had a better direct answer. It's funny. Scott's one of these guys that could probably text me and I could send it to him, but it's interest rates being higher stinks, but the SBA rates are always going to be tied to the prime rate, which is going to be better than any alternative you can get out there.
Yeah.
And frankly, there's still going to be premium loans, just more due diligence to get through to get them secured.
Awesome. Does some of the KPIs you mentioned come in A2X as a report?
Yes, this kind of goes to what you were saying a minute ago, Jeff, where, okay, so getting your profit and loss statement within your accounting system, whether you're using, Xero or QuickBooks Online, one of these other ones, it's really important to not have that P&L be garbage, right? And so here's what a lot of sellers do. I get a deposit from Amazon and I book it as sales, and I'm ignoring the fees and I'm ignoring the fact that some of those sales happened in June, some of them happened in July, right? And so what A2X does that is very helpful in this analysis is A2X makes it to where when I pull up my profit and loss from last month, it's actually accurate. It's giving me some of the data that helps me know that this is what I really did. And so, for instance, I showed you guys a few slides ago about how to calculate true profitability. If you don't have good bookkeeping, getting those ROII numbers and determining what those metrics are, it's going to be very fluffy and it's not going to be very accurate. And so A2X, I don't think, Jeff and Craig, I don't think you can go into the A2X tool and get these exact KPIs because they're kind of pets of Tyler. But
Also, didn't you make some of them up?
Yeah. So yeah, the fact Tyler invented PAG and return working capital, and they're like, yeah, A2X, they love Tyler. They haven't baked my KPIs into the tool. It's fine. But honestly, guys, seriously, don't even try to calculate these unless you have good data. And I think having good data means you got to have good tools like A2X.
Awesome. And this one, I'm also curious about this because I think anyone who's running a business thinks about the long-term succession planning. When do you think will be the best time to sell your Amazon brand as far as multiples are concerned?
Yeah, I mean, for this question asker, the implicit question is obviously if you could have done it 3 years ago, that would have been absolutely perfect. But given the fact that we didn't, this year is going to be a tough year. And so what you're asking me to forecast is when are the interest rates going to go down and when are the capital markets going to change from currently being very puckered up to not being puckered up? My opinion, as a guy that's sitting on the acquisition side, as a member of the board of this one aggregator, and as a guy who wants to help my clients sell, is that probably about a year from now. So thinking kind of summer 2025 is probably going to be a strategic moment to start looking at exiting. It's going to depend on the category and the makeup of the business. So anything that you can do is just kind of bonus answer to that question. Anything you can do to add a repeat purchase intent to your product. So if you can do aggressive subscribe and saves if you're an Amazon seller, or use some cold email or warm email to do retargeting of your Shopify sales to try to get that lifetime value of your customer up. I'm seeing a lot of evidence that the acquirers are now viewing those kinds of repeat purchase brands. So, like for instance, I had a client who sold a type of purifier. Well, the purifier was a good product, but the filter club that he was able to get people to sign up to that sent them a filter every quarter was actually what drove the multiple of that business up to more of a premium multiple. And so if there's anything you can do in your catalog while things are still down, that'll help you. But if you ask me for a date, I would imagine probably 1 to 2 years would be ideal.
It's nice that you're seeing light at the end of the tunnel, though.
Yeah.
It's a good thing. I have like, Tyler, I could ask you 1,000 different questions, but I think for the purpose of this webinar, we'll leave it at that because mine aren't all accounting related either. You just have an interesting point of view and really appreciate your expertise. So again, if you have any questions, please feel free to either reach out to Tyler at Seller Accountant or A2X if you want to dig into the software side of things. And the beautiful thing about Seller Accountant is they're one of A2X's top partners. So if you have any A2X related questions and you need accounting support, Seller Accountant's going to be one of your go-tos. So thanks again so much, Tyler. I hope you have a great day. Thanks for joining, everyone.